Hi, good morning, good afternoon, and good evening. We'll take a bit of some time to just analyze the Zanaco financials. This is a summary of income statements, basically a summary income statement. So, and I must actually mention that the financials I was actually getting were not detailed. These are just abridged financial statements, so there isn't so much information. Where possible, I was actually assuming, but that was very educated, the assumptions or guesses. Yeah. So what is interesting is that in 2020, the total operating income went to 2.3 billion from 1.4 billion in 2017. And checking on the annual growth rate, that is 2017 to 2019, it was at 4%. So ideally, or should I say, if one just looks at the actuals against the actual 2020 against the historical trend, you would actually come to a conclusion that Zanaco in 2020 did perform better. Yes, it did. But then, if you bring in the forecast, you look at the growth rate, the compounded annual growth rate from 2017 to 2019, and use these rates to grow your 2019 numbers. This is what you would actually get. So you have your forecast. Instead of the total operating income going to 2.3, it would actually go to 1.598. So looking at the variance between the actual and the forecast, it does show you that on this line, Zanaco did actually perform well in terms of the total operating income because it increased by 48.4%. Profit before income, the actual is below the forecast by negative 19.3. So then what it means that in between here, their costs actually grew at a much higher rate in between the operating income and the profit before tax. This is why you have your actual, which is lower than your forecast by 19.3%. The growth as well on income tax, this was a positive because you paid or you were charged less tax than you forecasted. So in total, the profit attributable to shareholders reduced by 22%. It should have been 264. It actually went to 206. So as much as the performance in 2020 is better than the performance in 2017, 2018, 2019, still one would still argue that Zanaco did not actually perform better. If you are to use the same growth trajectory or the CAGR here to grow your forecast, we expected that the profit attributable to shareholders should have actually been around 265 million kwacha. And the earnings per share should have actually grown by 18.3. So based on the forecast, we are actually saying the actual EPS reduced by 22%. So in this case, Zanaco did not perform better. That is compared to the forecast, compared to the actual growth, the compounded annual growth rate from 2017. So if we're to forecast into the future, now here we change the CAGR instead of 2017 to 2020, since we have the 2020 actuals. So we basically widen the net and compute CAGR from 2017 to 2020. So this is what we're actually using in computing this. Then now we're actually saying we can, since we have these compounded annual growth rates, we can use these numbers to forecast into the future just for 3 years. So it shows if you buy your shares today, or you stick around instead of selling your shares on the secondary market, the Zanaco shares, you just stick around. By 2023, the EPS, earnings per share, will be at 0.25. So what does it mean? We do this, we check on what it is today at 0.143 minus 1. So you would have actually grown your investment by 77%, or your wealth by 77%. So stick around. I think Zanaco is still a very good investment. I think so. Okay. So ideally, it just shows you so the CAGR 2017 to 2020, the income tax expense actually tops it all. Seconded to profit before tax, before income tax. And the EPS also grows at the same level of the attributable, profit attributable to shareholders. Okay. Then we look at just scroll it a bit, the balance sheet. As you're aware that banks are not capital intensive, so you would expect their property, plant and equipment to be quite lower than most of the other investments in here. Cash and balances with Bank of Zambia. How do I do it here? So you can see in terms of the CAGR growth, the cash and balances with Bank of Zambia have actually increased, or Zanaco has increased by 12.6%. This is on annual growth. Balances with other banks, this is what has really increased. It is at 5.5%. Whereas the trading assets at 47%, because we used the CAGR from 2019 to 2020 here. Loans and advances to customers, it has also increased from 3.2 billion to 7.3 billion in 2020. So what it means here is that the number of customers are actually getting loans from Zanaco. But again, this is where you can actually assess the risk. This is where the risks are. This is where the risks are. This is where you're actually going to find your NPLs, potential NPLs, non-performing loans, especially if the economy is not doing fine or is getting depressed because of this pandemic and many other things. So you expect that so many people, so many customers that are getting loans from you may end up failing to pay. So this is a potential line for non-performing loans, which is actually a very huge risk in the banking sector. Then deposits from other banks, obviously it grew by 394. I don't know what was happening in the previous years, but the customer deposits, this is very interesting. I checked the annual report for 2017. I was searching for customer numbers. I didn't see them. I wanted to estimate how many customers they could have now with the 15.7 billion deposits from other banks, from the customers. So they've grown this portfolio. And in a way, this is better because the loans that they're giving to customers against what they are receiving from their customers as deposits is just 46%. So this is good. What was going to be worrying was if the customer deposits are actually lower than the loans and advances they give to the customers. That was going to be a huge risk. So this is where they get their revenues from, interest and all that. From where? From giving loans here. But again, if they increase this part, it means that they actually increase the interest received, and interest received for them, that is revenue, it's core revenue. Then it actually increases the bottom line down there. Looking at how much they are receiving in customer deposits, how much they're actually giving out, you would even say that they are quite risk averse in terms of borrowings. The number is not that huge. Obviously, it has just increased by 25% on an annual basis from 2017. Then this also reflects the current economic situation that we are in because of the pandemic and maybe other reasons. This bank is very risk averse. Check the way they were actually borrowing compared to what they're actually giving out there. The jump was just in 2020. Oh, by 234%. I don't know what could have actually motivated the Zanaco to increase their borrowings. Is it the situation we're in today? Is it because they needed more financing in anticipation to overwhelming response from their customers in terms of loans and all that? I don't know. But still, the amount is still a bit insignificant. That is, in my view. Interestingly, equity is actually growing at 4.6%, which is okay. Dividends, they've grown at 260%. From in 2017, Zanaco never declared any dividends. I don't know when it actually went on when it was initially listed on the stock exchange, but they have been increasing the dividends payout That is in terms of absolute numbers. We have to check on the percentages by 260% on annual growth rate. Now let's check where the money is coming from. If we go to the cash flows first, I don't know why I took the cash flows down. I should have pressed them up there. Wait. I thought I had cash flows. Oh, okay, it's here. Again, here the cash flow statement is not in details. So the data that I was getting, like I said, that these are just abridged financial statements. They're highly condensed. You have to add 1 + 1 just to determine what is happening, and maybe use a bit of educated guesses or assumptions. So again, here, the cash from operating activities, net cash from operating activities, using the CAGR 2017 to 2020, you can see that it is actually growing at 26.8%. But what is so interesting is that the operating activities 2020 compared to 2019 has grown at over, is it 10,000? Is it 1,000? Has grown at over 1,000%. This is where they generated. Where did this cash come from? Maybe that will be the question that we have to ask. Where did this cash come from? And the investment, obviously, it was at 3.5, meaning that this almost cancelled. And you have your financing activities, which is coming to 679. If you check your net incomes here, if you check the net incomes and just add back depreciation and maybe a bit of financing charges if they are there, it cannot go beyond 500 million kwacha as your EBITDA. Yet the net cash generated from operating activities in 2020 went to 3.6 billion kwacha. That is jumping from 305 million to 3.5. What really happened? What techniques did Zanaco use to magically grow this particular activity? This is what I discovered. I may be wrong in the way I was analyzing these numbers, but this is what I discovered. First, if you bring in all the cash for receivables, that is from your first half of your balance sheet, you get the differences just to check whether there was a cash inflow or a cash outflow. Here you will see that the balances with other banks increased, meaning that it was an outflow. Trading assets as well increased, meaning that it was an outflow. Investment in securities increased, it was an outflow. So in 2020, just from the first half of the balance sheet, Zanaco did not generate any cash. In reality, there was actually a drain of 6.862 billion, 6.8 or 6.9 billion. Yet the operating activities was at 3.5 or 3.6 billion positive. So went on. It was a bit of a puzzle. Went on. Again, now went to the last half of the balance sheet. Because what happens is, the last half of the balance sheet is basically for financing. They say the first half of the balance sheet is what you would actually call the eyes. These are assets that you can see. Whereas the last half of the balance sheet is the ears. It is what you hear. It is what actually funds what you see. So here again, yeah, frankly speaking, the first half of the balance sheet, it was all generating, and it's supposed to, it was generating outflows. But the outflows were not as high as in 2020. Yet the operating activities, net cash from operating activities down there, it was high, about 3.5 or 3.6 billion kwacha. So here, let me not confuse you. Let me do this. Okay. So this is what happened. Deposits from other banks increased, meaning that they had the liquidity, but this wasn't so much. This wasn't too much. It was just 407 million kwacha. Wow, this is where they made their money. You can now see the security. Customer deposits. So 2020, as much as it was a very bad year, at least to humanity, one would actually say for Zanaco, it wasn't a very big problem in terms of the customers that were now depositing into their banks. So the question is, what led to these customer deposits? What led to this? In a year where you think, where ordinarily one would have thought that customers would be cash constrained, and whatever reserves or escrow accounts they have in these banks, the first instinct that they'll go and mop out all the monies that they have in the banks. But I don't know. Maybe as you, as my LinkedIn connections, YouTube, you can just give me an insight what was happening here. Why the customer deposits increased from 2019 to 2020 by 5,000% or by 517. What was happening? So this is where they generated those funds that were actually, that we saw down there. This is where they generated the funds. Okay. So then we can now match these numbers going to the working capital. So we can see what was happening here. The investment in securities, this is part of the investing, and it will actually sit under investing activities. So it was 2.9. You can see we're able to match it with a cash outflow on investing activities of 3.5. Here on the net cash used in financing activities of 620 million can also be matched against the borrowings down here. So then when you look at the working capital, come down here, this is what we are having. So in terms of the working capitals, they managed to generate cash from working capital of 2.3 billion. This answers the first part here on the operating activities, where the money was coming from. Because we do not have the details, so we have to do a bit of some reverse engineering, and I think we got it right. Okay. So went to the previous abridged financial statements, that is from 2017 to 2019, just to get the depreciation, because I wanted to calculate EBITDA, and this is what I got. But then it does show you, if you do like this is 2, that, this, just to get CAGR. So you can see that the CAGR, that is compounded annual growth rate on depreciation, is 0.8%, or 8%. So coming here, then it means that you're going to have that times 1 plus that, giving you 41. This is the number that is there. So there's a formula here. This is the formula that we have put in there, just to show you how I got depreciation for 2020, because the abridged financial statements, remember, it's about 2 pages. There's nothing much that you can get from there. You have to work in reverse. The similar principle was actually used on the interest expense, getting that. So that if we have depreciation, we have profit before income of interest here, then it becomes easier for us to get EBITDA, because then we add all these in getting the EBITDA. But what is so sad, again, it reviews, maybe also it is the environment that we are in because of the pandemic. Obviously, the operating cash, which is EBITDA, we expected it to regress, and this is what happened. So here, one is able to see the effects of COVID, but there, one is not able to see any effect of COVID. Why we had so many customer deposits? What was really happening in 2020, when we know that there was a problem? We still have this problem anyway. So you can see, if you do like this and press F11 just as a quick, you can see that EBITDA, it was growing at a steady rate. Then in 2020, it went down. Let me just delete this. Just wanted to show you. Okay. So it doesn't look like it was a very good year for Zanaco, but what is so interesting, they had more customers that made deposits. One would assume that there were a few customers, but I think there were so many customers. This is quite a huge value. Then try to use the payout ratio, whereas dividends over EBITDA. I wanted to know the real cash, the operating cash here, how much is actually being given to the shareholders before you think of dipping into the reserves. Like one of my colleagues told me that no, companies sometimes they have these strategies of actually giving dividends from reserves. Obviously, those reserves, what it means that you do not have any current use for it. So you could as well do a cash sweep and just give it out. So using the payout ratio, that is based on the operating cash, which is your EBITDA, it does show that in the year when your EBITDA was quite low, not very low, lower than the previous years, you gave out dividends of about 17% of EBITDA. But then when you look at the net income, because most of the companies, when they are crafting these dividend policies, they don't link the EBITDA to the dividend ratios. they actually look at the net income, which is somehow subjective. So it does show that you moved from 1.5 to 17%. This is still a bit low, a low number in terms of payout ratio. From my quick research that I've done on the banking sector, EBITDA or dividend payout ratio is about 35 to 55%. So they've been very modest in the way they've been actually giving out dividends. And I know why, I can speculate why there was an increase in dividend payout in 2020, because the market price per share, the MPS, is going down. So how do you encourage your shareholders and those that want to buy shares from your company? How do you encourage them? Is by giving out slightly bigger dividends. There was still not going to be any harm had they given out, say 40%, of, actually I gave 36, let's say if they had given out 55% of their net income. What have I done? If they had given out, if they had given out 113, there's still not going to be any harm, because you're still going to be within range. But that is okay. Then the share price that 1st December of each year. You can see in 2017, the MPS was quite high. It was 0.97. I still believe that the intrinsic value of these shares is much higher than the market price per share. I always believe that the MPS is generated from a world or a universe of guesses. I don't think the shareholders, they know, or the would-be shareholders, they know the true value of the shares. So they act based on perceptions. I think so. So it was 0.9. Now look at where it is today at 0.47. And this information, you can obtain it. I got it from here, not InfoTrax, from Kwaisi FX on the share price. I needed this number to do certain computations to get the PE, MPS over EPS. This actually also looks at the risky issues. But what is so worrying is that the PE ratio is reducing at a very high rate. And as we go through the dashboard, I'll explain what is happening in the market, where the PE ratio is in terms of the banking industry. That is globally. I'll explain that. Market capitalization, it is actually going down simply because of the share price that is regressing. So market capitalization as well is actually going down. So customer perceptions, not customer shareholders perceptions, the market's perception has a huge impact on the market cap. So using that to try and find the EBITDA multiple, that is the enterprise value, because then this ideally becomes your enterprise value if you are using your market share. So you can also see that the EV/EBITDA multiple is actually going down. Here I would say in the industry, the PE ratio is about 13. That is global bank industry, and I'll give you the data as we move on. Here, the enterprise value should be about 7.5. The EBITDA multiple, about 7.5. Look at where we are. Oh my God. The debt EBITDA, ideally shouldn't be above 3.5, depending on the nature of the company. If it is in the energy, you expect that the debt EBITDA should be 6 and below. For banks, I think it should be 4 and below. But you can see 2020, this also reflects the issue of COVID. It clearly shows. Okay. Here. This is basically perceptions, because it's coming from here, from this line. Then we have the dividend per share down there. Okay. So we can then now go to dashboards. So this is what is happening. The stock price, which is in blue, you can see it going down to 0.47. Yet the dividend per share is actually growing. And this is simple. Maybe this is the only way that you can uplift this, taking it up. As you increase your dividends, you're actually sending a very good message to the market, so that this line, this blue line, also in 2021 is expected to start going up. So the question, okay, I'll still get to Rob's question from African Financials. Then the PE ratio, this is also being influenced by the MPS on top. This is why it's going down. In 2017, it was in a very, very, very good place. It was 12.27. In Netherlands, the PE ratio in the banking sector is about 17.7. That's quite huge. That's quite huge. It definitely means that the MPS is higher than the EPS by some good distance. So when you look at the global level, the banks, as at in 2021, they were at, at 12. They were at 12. So I just plotted just to show that this is where the banks at global level are with the PE ratio. Yet our Zanaco is going down, and we know it's because of the MPS. And this is why I still argue that the intrinsic value for Zanaco is much, much higher than the market price. So the EPS, this was 1.39. 1.43, slightly went up, but we know that it should have actually been about 1.8, somewhere there. It should have been much higher. Now, looking at Zanaco against the peer group, this is just the bank industry at global level. And I was getting this information from Info Analytics. So the EV, or what we call EBITDA multiple for the banks, it is at 7.5. That is a peer group. I was matching the colors here with the color theme scheme up there, black, so you're able to see clearly. So this is what you have. Whereas sorry, whereas for Zanaco it's going down, and I've already explained why we're actually seeing this trend, but this is worrying. Here, I was also trying to explain and Ray advised that the columns, between the space between the bars must be slightly narrow. Actually, the original one was like this. I like making them slightly smaller without grid lines, but the advisor, the grid lines have to be there. So I was just experimenting. So it looks slightly different from that. So the debt EBITDA, I'd already explained, but you can see that it's going up, which is a problem, which is a very big problem. Market capitalization is in terms of the amounts. Sorry. So it is going down, but since I'm using 2017 as a base, I'm saying it's 100%. You can see the way it is sliding because of the market price, the MPS, at 752.48. Who knows if Zanaco doesn't fix this in terms of the dividends they're paying, the correct sound bites they're sending to the market, it might find itself at maybe 44 or so, or 43%, which would be worrying. But we expect that the market capitalization must start going up. So coming to, this is very controversial. And I'll just find the numbers. I hope Rob is watching from African Financials. I had to, this is why I delayed. I'd promised that I was going to send this analysis by midnight. Then Rob sent a question where he was asking me at what would be the intrinsic value for the Zanaco shares. First, he's asked, are the shares, are they undervalued or overvalued? I answered without having done any computations. It was off the cuff, but I needed to justify how I came up with that particular answer. I said the shares, the Zanaco shares, are undervalued. I believe that the intrinsic value is higher than the market share price. Then he went on to ask, what is the value for what is the intrinsic value? So then now I had to do a bit of some computations. And this is where check if the assumptions, if you think the assumptions are wrong, please, you can just, this is what I did. First, at New York University, got this data. This is was done by Aswath. Damodaran is a professor. So looked at all the industries with their beta, their DE ratio, because when you're valuing the D ratio. You don't use the D ratio for the company, use for the industry. So I had all these numbers. I don't know the D ratio for the Zambian banks, and I knew that it was going to take me a lot more of time, but it was fair to only look at the D ratio for the whole banking sector. So if you check on the banks, I had three areas here. The bank money, which was the D ratio was 177.75, yet the beta was 1. The bank's regional was 0.57. I think it was an investment banking at 1.46 beta. Then this was one of the data sets I used. Then I also used the equity risk premiums for the countries. Again, this is done by Moody, but still obtained it from New York University. So if you check on the country risk premiums for Zambia, we're at 27.97, I think equal to Zimbabwe. Where is Zim? Yeah, equal to Zim. So we have the same risk equal to Zim at 27.97%. So use these numbers, then also went to World Bank website to pick the inflation. This is data from 1960 to date. I had that data. So how did I use this data now? This is how I use the data. The industry, we had these three banks with their beta. It was a matter of choice which of the three I should have gotten, because I know that Zanaco is not an investment bank. So I picked the regional in a beta rate for the banks. The money center, I didn't even know what money center means, so I picked this one. It was, it was safe to pick this. So this is what now went into my computations. The risk-free rate of 7%. Here, I think I'm not far from the truth. This is basically on the interest, which is being picked from here. Sorry, should have picked dependence. Okay, down there. Then pick the risk premium, 27.97. This is basically the risk for the equity risk premium of Zambia. So just to show the countries in here, those that are in Africa, Europe, and West Africa, just to compare their Moody's rating and the equity risk premium and the country risk premium. But we normally we do pick the ERIM when you're doing these valuations. So that is what I picked. If you check on the interest, the 7% is okay in my opinion. So going to the annual interest here, the annual interest of 7%, the DE, remember I was picking from the beta. If I go there, this is where the number is coming from here on the bank's regional. Like I said, that is what I picked. I could still be wrong. They did actually split the debt and capital, giving a WACC of 16 point, weighted average cost of 16.78. Whereas the cost of equity, it actually went to 23% based on the computation that we actually done here. Okay. So meaning this number now, the WACC, fed in the DCF here, which was that. So we had the EBITDA, which I use now to grow. If you can see that the EBITDA here, it is reducing. I would have actually come up with an assumption, and is assumption where EBITDA should have been increasing, but I know from 2019 to 2020, EBITDA has been reducing. So I use that compounded annual growth rate to compute. You can see the formula on top. Then in the terminal year 2026, because I use the forecast for 5 years, 2026, it's basically adopted all the numbers from 2025. I have to explain this. So giving us the operating income, capital expenditure. I use the levels of depreciation, meaning you just have to be replacing that. So the same depreciation numbers, that's what I brought in here because I don't know their investment policy. But if we are to just replace the assets that are depreciating, this is why I use these numbers. I hope Rob is watching and listening. Trust me, I ignored the deferred taxes here. Obviously, it wasn't going to fundamentally change the analysis because then I needed to model. I normally model, it's quite a bit complex. I normally model the deferred tax so that it becomes easier to bring it in here, but still it wasn't going to change any numbers significantly. So then the changes in working capital, this is what I picked, this number for 2020. I just picked the total down here, just the 3. But I know I should have, if I wanted, I should have picked this, but this was an anomaly, and we're told in analysis, you don't go for anomalies, or I should have picked the 482 here. For 2020, it was 2.3 billion. That is what they released from their working capital. But I went the modest way and picked the 347. Obviously, here we have the tax computations and all that, the tax rate. These, they are driven by the numbers that we have on top. These are half-year factors. Sorry. So giving the net present value of 2 billion. So then I brought in the PGR, like I said. I picked the US CPI for 15-year average, which is 2%. I think most of the computations I've seen, most of the evaluations I've seen, 2% is not outside normal. It is basically a normalized rate. So you have the present value of forecasted cash flows, which is 2 billion. Then we have the present value of the present value of terminal year, which is 1.9. And I sent this workbook to Rob, and I hope he has had time to go through and make some few corrections where I went wrong. So what does it mean? It means that the enterprise value is, if you had to use DCF, is 4 billion. But if you had to actually use your market price shares to get market capitalization, it will actually be at 678 or 679 million. And I don't believe that Zanaco is worth 600. It should be more than that. If one was telling me it's worth 2 billion to 3 billion, I would understand. And looking at the volumes that they're actually pushing, this is very low. So you can see the difference of, if you have to compute your enterprise value using your capital market capitalization and the DCF, you would actually see the difference. The difference is quite huge. So if you have the enterprise value of $4 billion, kwacha, sorry, kwacha. In dollars, how much would it be anyway? in dollars to be just 181 million, which I think for Zanaco, this is a fair pricing. This is a fair valuation. Rob, I'll need your insight on this one. So now you have your number of shares, which is that number. Let me do this. Remember that it is raised by 1,000. So the intrinsic share price is basically the total enterprise value divided by the number of shares, which is 2.7 kwacha. In dollars, this will be per share. It will be about about 1.3, 0.13 dollars per share, which I think is not too much. So then you compare the 2.77 against the MPS of 0.47. So the gap is very huge. And when you do these valuations, you find that the intrinsic value and the MPS, market price per share, is huge, especially where it's actually above, the difference is above above 20-30%, then there could be three things that are happening. One is that could be that you have created very wrong assumptions, and they have checked. I've passed you through the assumptions. It's up to you to see whether these assumptions are wrong or right. So it could be that the assumptions are wrong. That's the first thing. Secondly, it could also mean that if the assumptions are not wrong, what could be the problem? Maybe it's that it is just that the market is getting it wrong as well. And maybe I'm right. So we'll have to look at all these things. So I brought in the sensitivity to show the work that if, say, for example, it moved from 6.78 to 10 to 11 to what would be the valuation? So the valuation keeps on going up. Okay, so thank you so much. See you next time. I think our next assignment is to value Airtel. I hope that data is there on African financials, the abridged financials for Airtel Zambia, so that we keep on pressing from one company to another. In the next 1 month, we'll be done with all the companies listed on the stock exchange. For those that have issued the abridged financials for 2020. Thank you so much, and bye-bye.